The first atomic bomb was dropped on Hiroshima.
Oh, the humanity!
The fires of frustration and discord are burning in every
Let us
city.
not forget for a moment the toils and efforts that lie ahead.
They say that those who forget their history are condemned to repeat it. This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey, author of History Lessons for the Modern Investor, and your guide to financial wisdom in the past, present, and future. You ready? Good. Let's get historical.
Can you hear me now? Well, last week, a lot of people found out what no bars really means. Verizon went down nationwide and phones said SOS. Text wouldn't send, and for a few hours, your very expensive smartphone was basically a very expensive paperweight. After all the speculation about cyber attacks and foreign hackers, the big reveal, not a movie plot, just bad software. A glitchy update took a giant network offline. Efficient, centralized systems work great, right up until they don't. One mistake in the code and suddenly millions of people are staring at a dead screen, wondering what just happened. Now that's not just a tech story, it's a money story too. Most portfolios and financial plans are built roughly the same way, extremely efficient, right up to the point where something breaks. One stock, one sector, one employer, one strategy doing most of the heavy lifting. It feels smart until that carrier has an outage. The lesson from Verizon isn't panic, it's redundancy. Don't build a financial life that only works when everything's perfect. Build one that assumes there will be glitches, market drops, job changes, interest rate shocks, and still keeps you moving. You don't control the network. You do control how many backup paths you have. So if you know someone, or you are someone, who reacts to every market wobble like their phone just lost service forever, share this video with them. Because a good plan should keep working, even if those bars disappear for a while. After the break, I'll be back with this week's history lesson for the modern investor. On January 24th, 1848, gold was discovered at Sutter's Mill. That's when a shovel and a rumor literally rewired the world. On January 24th, 1848, a carpenter named James Marshall was inspecting a sawmill channel on the American River near Coloma, California, when something in the water caught his eye. Small flakes of metal glinting in the cold current turned out to be gold. Within months, words of the discovery at Sutter's Mill leaked east and then across the ocean. By 1849, almost 90,000 people had poured into California. By 1852, that number had swelled to well over 300,000 fortune seekers from the US, Latin America, Europe, and Asia. The California gold rush had begun. What followed was a frenzy of risk-taking and reinvention. Some struck it rich, most did not. Many of the biggest winners never even touched a pickaxe at all. They were the merchants who sold shovels and supplies, the bankers who financed the claims, the shopkeepers who fed the crowds, and the railroad and shipping magnates who moved all those people and goods. The gold rush reshaped global trade routes. It sped California into statehood, and it helped permanently tilt economic and political power westward. But for the individual prospector, it was mostly a hard, uncertain slog. Proof that once a sure thing becomes a stampede, the odds quietly shift against the latecomers. Here then are 4 lessons for the modern investor from Sutter's Mill and the California gold rush. First of all, don't confuse a gold rush with your retirement plan. The first to stake claims near Sutter's Mill had a genuine edge. But as word spread, the easy gold, well, air quote easy, quickly disappeared. Late arrivals paid higher prices for tools, food, and transport, and they had to work poorer ground. Many went home broke. Today's investors replay this pattern whenever a sector or an asset class goes vertical. Dot-coms in the late 90s, housing in the mid-2000s, crypto or AI stocks more recently. By the time something becomes a cultural phenomenon, most of the easy money has already been made. And a sound retirement plan can benefit from growth and innovation. Not saying they can't, but it cannot depend on you finding the next vein of gold for everyone else. Second, it's often better to sell shovels than swing them. History's biggest winners from the gold rush weren't the prospectors. They were the businesses that served them. Levi Strauss, he sold durable pants. Sam Brannan sold picks, pans, and supplies. Wells Fargo helped move money. And they got paid whether a miner struck pay dirt or nothing. So for individual investors, this should translate into owning broad, diversified exposure to the underlying picks and shovels of an economy. Industrials, infrastructure, financials, and wide moat businesses that benefit from trends without betting on a single hole in the ground. Instead of trying to out-prospect everyone in a hot area, build a portfolio that gets paid while others do the digging. Third, beware the hidden cost of chasing the strike. Reaching California in 1849 wasn't cheap. Many people sold farms, borrowed heavily, or abandoned steady trades to chase a very speculative jackpot. The real cost wasn't just passage and tools, it was the opportunity cost of everything else they gave up. Investors make a similar trade when they repeatedly jump from strategy to strategy, liquidate diversified holdings to go all into the latest story stock, or raid retirement accounts early to fund a hunch. Long-term financial health depends less on dramatic wins and more on avoiding self-inflicted wounds. Before you chase that rumored load of gold, count all the costs, the taxes, the fees, the lost compounding time, and the stress of potentially being wrong. Finally, manage your risk like a merchant, not a prospector. Prospectors often stake everything on a single claim. Merchants and financiers, by contrast, spread their risk across many customers and many seasons. One bad winter didn't sink the general store. Your portfolio should act more like the store than the solitary miner. Diversification across asset classes, sectors, and geographies, a sensible allocation between growth and stability, and a tax-aware withdrawal plan all help ensure that one bad year in retirement or one bad idea doesn't ruin the whole enterprise. The goal isn't to hit the one giant strike. It's to stay in business year after year. Here's a final thought. James Marshall's discovery at Sutter's Mill was real. There was gold in them there hills. But the way most people responded turned a real opportunity into a lottery ticket. The modern equivalent of that is mistaking headlines, hype, or a friend's can't-miss idea for a strategy. As an investor and a would-be retiree, you don't need to be the first one in the river. And you certainly don't need to bet the farm on a single pan of gravel. You need a plan that lets you participate in growth, get paid like the shovel sellers, and keep enough reserves that you're never forced to gamble so you can survive the winter.